Hi, everybody. Thanks for coming. It's John Diaz Group. I have Fernando with me and Fabian from the mortgage company. We're going to be going over a lot of information. Hopefully, it'll help you out. Our team's been in Top Agent Magazine. Here's a team with our buyer's agents. Like I said, Fernando's with here today to answer any questions you have as well. We're going to be going a lot of information, the peers and facts about buying, reality of the market today, success, the steps to ownership, financing, also the $25,000 bond program, and the next steps to buying. As you can see here in a chart, you can see, the first step is, coming here to deciding you want to make the choice to buy. The second agent we recommend in the process is finding an agent, which we're here to help, because we help from there with all the other steps from securing financing, identifying what you're looking for in a property, finding the home. When it comes to the title company, the appraisals, the contingencies, making an offer, inspections, all that stuff we're going to cover a little bit later. We're going to help you through that whole process, get you to closing so you can move in, enjoy the house, and start building wealth in the property. All right. Some of the things, people think about, I can't afford. But the good thing is we're going to do some of the math, and even though the rates have gone up, right now we're working on some of the seller concessions to help with buying down the rates and other things like that. There's never a bad time. Something else we'll be covering a little bit is you really can't time markets. There's a variety of programs for financing, including the first-time home buyer. So one of the biggest things I'd like to say is, there's more money in real estate than in anything else. There's more money in real estate than the stock market. You look at it, 34% of people's wealth are in real estate versus 26% in stocks. Then you can look bonds and savings accounts and bonds. So, we've shown you some other slides showing how the appreciation, and then obviously if you pay it off, it is, and especially for most people that are paying 100% interest in the rent payment, it's the biggest way to build some wealth. So again, the renting versus owning, there are some advantages for renting that, you don't have to put money down. There's little or no repairs. Short-term leases, 1-year leases generally, and you have mobility to move. So there is advantages in renting, but if you're going to stay for 5 years or longer, the advantage is in buying. Okay. Here. So this shows home prices. You go back to 1970. I remember my mom's house. She bought, for like in between that 20 and 60,000. I don't remember. I think 40, 50,000. That house today in 2022 is worth 565,000. So obviously in between these, like in 2008, some of the prices went down, and that was the biggest decline and cycle in prices for homes. But then shortly after that they regained, and then 10 years later they've doubled in value and so forth. So here's a chart about home equity appreciation. It's just an element, it's just an example, but it shows that 250,000 over time. Let's say you put $50,000 down, you got $50,000 equity, but 22 years later, as the property goes up in value, then you have 518,000 in appreciation, and 30 years later, based on the chart I showed you before, the house could be worth 810 with the appreciation, the fact that you paid it off. Now you're not paying rent on the property. You have it paid for the rest of your life, or you could, always rent it out for income into retirement. So it is the great, greatest investment. And again, this is just assuming a 4% appreciation, which is pretty close to the national average over the long term. I'm sorry. This chart here shows if you took a property and then you kept it for 10 years. And and this includes the money you put down. If you bought the property and then 10 years later you sold it, you would have made about $206,000. if you took that property, you know, and you keep renting and you invested the money you put down, you would have had 129,000. If you would have, you know, taken that down payment on the house and put all your rent money and all the other money into rent at 10%, it shows you those numbers as well. Okay. So the point is, if you're buying a home, you keep it in for 10 years, and that's the average. We're really overall people keep a home is 10 years. It's you know, the best investment. Okay. You know, why buy now? One of the big things, so rents are on the rise. I have some other slides here going to show you. You know, they've increased about 41% in the last few years. Again, what we just covered is long-term investment growth, the appreciation that you build and you're paying off their homes. There's tax benefits in it as well. You can get homestead. You could write off the interest on your taxes. Obviously, you have to talk to your accountant to figure out, you know, exactly what those amounts are. And then again, you get the stability of owning your home. You can fix it up, you know, and build wealth on it. You know, one of the reasons rents are also going up, you can see in Florida, institutional investors, there's Blackstone, American Homes for Rent have bought up, you know, 16% of the actual single family homes in the market. And then they keep them, they fix them up, and they rent them out. And they're looking for whatever, 6% return. And it appreciates, and they have those in like huge mutual funds where they own or trust they own these properties. But their goal is to increase the rents, right? And so that's part of why the rents are increasing. You know, rents are rising rapidly with inflation. You can see here what you see, $1,000 is $1,600. You know, so it's keeping up with inflation. You know, one of the benefits in Florida is Florida continues to grow. So, you know, we don't expect a bottom in prices because people are still moving. 709,000 people moved in 20 and 21. You know, and again, the average rents have gone from 1,215 to 1,700 a month. In Miami, they're much higher. You know, so you know the average renter is paying an extra $6,000 a year for a 2-bedroom home in Florida. If you had bought, you know, 2 years ago, that $6,000 you could be saving for retirement or using however you want. So it's an example of how you build wealth in buying versus waiting. Okay. Here's some other charts showing the same thing on the rent increases. Owning versus renting. Again, you know, I think this shows the same thing. If it were 1,200, you know, the total over 30 years. So, you know, even if you're paying a $1,200 rent, which is lower than the average right now, over 30 years, that's $435,000 and you don't own anything. You know, it's like you paid $435,000 in interest and it's gone. If you had bought a home, you have the 435 plus the 5% appreciated. That was the other slide showing an $800,000, you know, investment for you. You know, yeah, the taxes, the insurance has gone up a little bit in Florida, but the principal and interest are around the same. You can see here on a typical mortgage, you know, the first month it's almost all interest, but as you go down, look at 15 years, it starts getting more principal. So one of the big best things to do is pay extra on your mortgage. And say if you pay 13 payments in a year versus 12, or setting a couple $100 or whatever you can extra every month, it goes directly towards principal, and it can actually pay your mortgage from 30 to 22 years and saves a lot of money in interest. Because if you borrow 100,000, you end up paying like 300,000 or more in interest. That's just the way that mortgages work. You know, and then understanding equity and paying off the home. You know, I think we covered this a little bit in the last slide, but you know, at year 22, you're halfway paid off on the home. You know, so why would you hold off? You know, if you have a changing job, you know, a financing issue, which we're here to help to look at the alternatives. You know, if it's too expensive or short term. You know, those are things why people hold off on buying. But I'm going to show you one of the things that we hear a lot is, well, you know what, I'm going to wait for the market to go down. Well, it didn't work too well for the people who waited in the last 2 years, and it went up, you know, 40% in the prices, right? And the thing is, you can't always time markets. You know, I think you can see this here. You know, we've been on an 8-10 year cycle going up here. And, you know, we are on here. They say we peaked in March and we are in the down slide. So the good thing is, if you're buying, inventory's up 40%. The sales were down 20%. So that means more people are coming out to sell, and there's a little more to choose from. And there'll probably be a little bit more next month and the month after. But the prices are staying stable. Nobody's thinking the price is going to drop because, you know, there's low unemployment. Like I showed you, 700,000 people are moving to Florida. That with the low unemployment, there's not a big foreclosure coming. It's different from the 08 crisis, because in 08, everybody borrowed 100% or more. Now people have 30-40% equity. So if they do sell, they don't have to sell right away because they know they're getting equity, even if they do come across a hard time. So there's no foreclosure things coming. And the thing to do is to time, you know, it's hard to time the markets. I'm going to show you here. This is an older example at 200,000, but it's just an example. You know, if someone's rate was at 6%, the payment was 1,200. Now they're waiting, and let's say they drop to 190, but the rate 6.5%. Well, it's still the same $1,200 payment. Let's say it dropped $20,000. You know, in this case, it's to 10%, which is a huge thing. You know, but the rates are 7%. Well, it's still $1,200 a month, right? So if you wait now, you know, the rates are going to 7%. It could be 8.5% in the next year. If you wait till then, yeah, maybe the prices come down a little bit, but at the end you're relatively at the same payment, right? And you can't time markets. So if you can find a home where you can afford a payment now before the rates go up further, and you're going to stay there for 5 years, you should buy. Like we showed you in the slides before, if you stay there for 10 years, on average, people will have made $200,000 on buying and keeping their home for 10 years, right? So it is a big wealth in buying a home. And again, if you can get a mortgage payment now that you can afford the payment, then you should buy. And the other thing is, it's all right to buy at this price, well, even though the rates are high, because statistically, I'm going to show in the other ones, you know, the rates have been on average for 40 years around where they are right now. But they could go back down in a year or two. They're going to slow this inflation down. And then just the way here on one of the other slides where it goes up, you know, it goes back down, the interest rate. So if you bought in 3 years or 5 years refinance, if they go back down to 5 or 4%, you locked in, you're building well, you stabilize yourself, and then later on you refinance and lower your payment. And that's kind of the way to do it. And this kind of says is pretty much the same thing, you know, now versus, you know, it shows a 2% difference. So if you wait, let's say they go from where they are now, 6.5 to 8.5, you know, that could be a, you know, $1,400. What is that? $140 difference a month, right? So waiting isn't always better. And we're in a good point, I think, right now as a buyer, because there's going to start being more inventory. So I think, you know, as it starts sitting there for the sellers a little bit, you're going to be able to negotiate, maybe like in the past you couldn't negotiate, whether it be an inspection or negotiate, asking them to do a buy down and contribute towards to buy down your rate. You know, we can get the sellers to pay towards your closing costs or towards your mortgage to buy down the rate so that your rate's lower and your payment's lower. I think that's where the market's going to be going here in the next 3 to 6 months. This just shows the prices over time again. Okay. So here's a lot of numbers on home values, but you can see this is the total annual sales. And you can see, you know, over here where they were lower, then they went back up, and then they were averaged out. and we are now, pretty at pretty good numbers. So they don't expect a big fallout, because even though the inventory is, starting to go up, there's still only 1 or 2 months, 3 months supply of inventory. At 6 months supply, it starts balancing out. But we don't expect it to go so far out where the home sales are going to go down much. Again, this shows the average per square foot is 343 on a national basis. That's how the prices have gone up from 91 to now. This is the mortgage rate, so you can see this mortgage rates, 6 months ago were at 3%, now they're at 6. It's over a little bit over 6%. They have moved up pretty quickly, but they could go to 7, 7.5, 8.5, right? And again, what's relative about that is, there was a short period where rates are at 3%, but I think you can kiss that goodbye. We're never going to see that again in our lifetime. I don't think. But if you look at in this slide here, it shows you over since 1972, the average interest rate is 7.81%. So where we are right now, compared to the average from 1972, it's still lower than that, right? The average from 92 till today was 5.976%. And that's kind of where we are. So even though they're higher because we got used to hearing these low rates, over the long-term span of things, they're not really that high. Again, the inventory, that's the total number of homes if nothing was sold, how long it would take to sell them all. It's at about a 2-month, going to a 3-month supply, which is still a seller's market, even though it's moving, I think, every month a little bit towards the buyer's market. Okay. The days on the market are, these numbers run behind too, but on average, it was taking 2 weeks before the contract was based on a home that's for sale. All right. I think we'll see some of those go up to, a month in the next month or so. But it's still what's out there. If it's in good condition, priced right, those are the ones people are looking at, the ones that are priced right, and they're moving. Okay. This is unemployment on national numbers, but we know we're at a low of unemployment. That with inflation, they're trying to get it back up actually to combat inflation, but it's, the numbers are lower than the 5.4 now. Affordability has gone up, but you can see that chart over time. There's other times in 05 and 89 where affordability as a percent of income, 25% was where it is today. Remote work, there's a lot more people working from home. So that's changed the landscape, whether people are remodeling and fixing the house that they're in, or they've sold and they're buying a bigger home because they want a home office. That has affected things along with the people moving to Florida. This just kind of shows home sales, where, the first 30 days, where all the buyers come out. And then after that, only the new buyers are looking at the older properties. So the point about this is if you see a new property that came off the market and it's priced right and it looks good, those are the, you got to be acting on it because everybody else is looking at those. And that's what we're going to help you with as your agent. Okay, these are some of the numbers from Palm Beach County, but you can see there the average price of a home in 22. The national average was $560, but they're $600,000 now. For a townhome, the average price is $290. Okay, these numbers I kind of went over already. There is something where if you owned a home and you sold it, and then you go to another home, there's a portability tax. So later on down the road, if you, let's say you buy a condo or a townhome to start, and later on you want to go to single family home, you get an advantage of your lower tax on your current home when you buy a new home. There's a formula for that. It's a little bit more complicated, but basically there's an advantage for you to port your old taxes to the new home. Not 100%, but the point is you're going to pay lower than someone else who's just buying a new home when you sell your property and buy another one down the road. Okay. you know, one of the great things, you know, is we're here to help you as your buyer's agent, educate you on the market, you negotiate the contracts, help you through the whole process. Okay. And again, you know, you select an agent, there's financing, there's showings, there's inspections, there's appraisals. You know, you need a 4-point insurance or getting insurance and advice on how to get the lowest insurance. But the good thing is all those things, you know, the closing, reviewing the documents of the closing, all those things, does it have a clear title? Does it have any liens on the property? That's what we're here for. Your agent's going to help you. A lot of experience to walk you through all of those things. Okay. You know, hopefully you choose us to represent you and buying the home. You know, the good thing in Florida is the sellers pay the commission of the buyers, so it's not costing you to work with an agent to help you through the whole process. Okay. You know, the next part is pre-approval and that process. And Fabian from PRMG, if you could talk a little bit, introduce Fabian here, you know, about the pre-approval. You have online applications and so forth.
I think John covered almost everything about mortgages, and that's not really say that we can possibly think of. But with that being said, the reason why he is so extensive in the information he's providing is because it's real serious when you're buying a home. There's a lot of information out there. You can find a ton of information out there, whether it's legitimate or accurate. You don't ever know. The information that John has provided is real-time information. So what happens is, we've been in the industry for a very long time. It's very easy when the rates are 2, 3, 4%. Everybody wants to buy. The hard part is finding a property because everyone's in line to buy properties. As the market changes and the rates go up, properties go up, you have to know what you're doing, and you have to make sure that the information that you're getting is accurate and correct. And as professionals, we've had to transition to more as an advisory role and to work as a team with our borrowers and realtor and lender. We all have to work together because all three coincide all throughout the process. So on the buying side, what I want to give you guys is just some real important information regarding firms, how to qualify, what you can expect to qualify, what you need to qualify. And then once we have that, then our objective is to obtain an approval so that you can start putting offers and looking at homes. And that's where we all have to work together as a team. So I want to just reiterate a little bit about the market in itself and some misconceptions. I do have a lot of buyers that I speak to every single day. Some of them say, oh, I'm waiting for the market to drop. As John had said previously, we get briefed on markets every single day. And one of the reasons why we can't see that it's going to drop significantly compared to 48 is because since then, they've gotten so strict on the regulations for getting a loan from 08 to now, that anybody who's qualified for a loan has done it with verification of funds, assets, income. And everyone who has properties right now, we're sitting in the United States in over $2 trillion worth of equity. So people who have qualified have a lot of equity, have the resources and funds to be able to sustain it. Therefore, the chances of foreclosures occurring again are going to be very low. And if for whatever reason anyone runs into a problem, they can sell the house, get their equity, or rent it out because the rents are super high. So with that being said, there's really not a realistic chance that the properties are going to drop significantly lower. So what does that mean? It means that you're either going to pay high rent or and not buy a home, or buy a home and understand what you're buying and not be afraid, be prepared and arm yourself with proper information. And at the end of the day, the one thing that we do know is within the next year or 2 years, the rates will drop again. Maybe not to the 2 to the 3s, but it could be 4s and 5s, which is very important, because if you buy a property now in the 6s, you know, you may have a payment a little higher than what you normally would expect, but you have a home and you have equity and you're building equity and you're not paying rent. And the rent is probably going to be more expensive than the mortgage payment anyway. So when the rates drop down again, there will be a buying frenzy once again, because obviously everyone's still buying strongly enough. And if the rates drop to 4 or 5%, people are going to want to buy again, even more than what they're buying now. But if you have a home in 6s and you're paying a certain amount of money, when the rates drop down again, you can actually refinance your loan to a lower rate and maybe shorten the term. Instead of paying it up in 30 years, you drop it down to 20, 15 years, you still tend to have the same payment for less. There's still a great value in purchasing now. Now that we've established that, we want to arm you with information on how to get pre-approved, what are the most important things to get pre-approved, the programs available, how it's going to help you qualify. So the 3 major categories for qualification would be your income, obviously, your funds to close, and your credit. Those are the 3 most important pieces of the equation. If you're going to qualify as a first-time home buyer, usually FHA is the vehicle that we use that will give you the best terms. Less strict on certain areas, give you more money for less credit.
That's 3.5% down.
3.5% down. Fannie Mae has also offered a 3% down. But the difference between the two, so that you are clear, is that when you qualify with FHA, you get a little more spending power, because the ratios, everything's based on the ratios. So your percentage of what your mortgage payment is divided by what you make. And also that's the one ratio that we do. And then the second ratio is your mortgage payment plus your minimum monthly expenses divided by what you make. That's how you qualify. Those are the numbers. You can't manipulate that. That's cut and dry. So these are the things where we work as a team to try to get you approved, which program works better for you. So now FHA, ultimately, the benefits of FHA is you put 3.5% down versus a conventional 5%. When you have a lower score, maybe in the 620s, 640s, you get penalized a little more for conventional, right? Versus FHA in the interest rate. If you have a 700 score better, maybe you're going to have a better benefit than conventional. I'm just going to give you guys a little bit of bullet points so you guys will remember. But the reason why is when you put less than 20% down, the bank's going to issue mortgage insurance, right? That mortgage insurance can be eliminated in time when you pay down equity, right? So if we go, for example, let me give you 2 examples. One person has a 640 credit score. For FHA, it's considered decent. For conventional, it's considered a little bit low, right? So what happens? If you have, let's say, a $350,000 purchase on a home, and you're putting 3.5% in, FHA is going to give you a set mortgage insurance monthly payment, regardless if you have a 640 or a 740. It doesn't make a difference. It's always going to be the same mortgage insurance payment. Conventional actually either penalizes you or rewards you for your credit score. So let's say if you have a $230 mortgage insurance payment per month with FHA, right? If you have a 640 score with conventional, you may have a $400 mortgage insurance payment. If you have a 700 score with conventional, you could have $120. So there's a variant with conventional versus FHA. Now, the reason that a lot of people benefit by trying to go to conventional first is because that mortgage insurance, you have an opportunity to eliminate it in the future, once you pay down 20% equity. So if you put down 3%, and you pay down 17% more equity in the next few years, you can call the bank and have them do a reappraise of the house, and the conventional loan, the mortgage insurance will fall off. Versus FHA, it never falls off. It's for life. You'll be forced to refinance in the future. So everyone tries to go conventional if they can from the get-go. But if you can't, FHA is still a good secondary option. And it's still not that bad either. But you just want to know, because you're going to hear FHA into that. Now,
But if you have an FHA loan to get in, right, and it's better terms now, and you refinance in 3 or 4 years, you can refinance to a conventional loan, and then hopefully get rid of the mortgage insurance if it's gone up, or the mortgage insurance is lower. And
when you do a side-by-side comparison, if you have a lower score, you're going to be better terms with FHA.
And that's one of the things you do when you sit with them. You're going to give them, so you can see the numbers and explain more detail, compare the mortgage insurance on one or the other, right?
Right. So we do a preliminary assessment. Takes about 10-15 minutes. I ask certain questions, and then I can determine whether or not we'll be a candidate to purchase. If so, then I'll take it to the next level. We want to pull a credit report, see what the credit looks like, put everything into the system, and we can get an actual official underwriting approval from either FHA or conventional automated underwriting approval within the same day. That's what you need in order to be able to start looking at houses with offers.
So if I can say something, because that's really important on our end, we're realtors, you know, like I showed you in some of the other slides, if you find a new house, it just came out, it's priced right, maybe it's got everything, you don't need to fix anything, it's the one that you want. Well, other people are looking, that's the one, and it's priced right. That's the one all the other buyers are looking at, right? So one of the things as a real estate agent, we want to help you, and we want to beat out those other buyers, okay? So that's one of the things we work with Baby, when we do everything up front, we put some parameters in the contract where, you know, it's already here, so the real to you findings showing that it's been totally processed on his end, and it's real, and that we can give a commitment letter, which means it's, you know, it's the strongest letter of approval in a certain number of days. So we tighten that up so that we make your offer more competitive than most other agents who don't do any of those things. So if there's an offer where they didn't do this, and then we do it the way we structure it together with all these approvals and all these up front, you're gonna beat out other buyers, right? So that's that's one of the big advantages of why we're working together.
Right, and then that's, you know, it goes hand in hand, because if you, for example, if John or Fernando starts showing you a home that you're interested in, and you want to go see it, the listing agent will most likely want to make sure that you have an automated underwriting approval from paying the legitimacy that we discussed. And that'll give you the legitimacy in the eyes of the selling agent for you to be able to go ahead and put an offer on the property. Now, there's other advantages of having a team work for you, because if you're going up against 3, 4, 5 other people, first of all, we're issuing an official approval, number one. Number two, you know, when they contact us to see the validity of the approval, we're always available. We always respond. So that is very important for the listing agent to be able to have a physical person that's confirmed. Because if they're going to go down the list and they call 5 people and only one answer, 99% of the time we're going to get the offer. And that's very valuable. Now, before we get to that point, what I like to also do is, let's say I issue an approval for $350,000, right? Not every $350,000 home is the same. Some have HOA that are higher, some have taxes that are higher. So we want to make sure that we're comparing apples to apples when we're going out to look at a home. So I always ask you to send me out. So if John is sending you listings, if Fernando's sending you listings to look at, and you guys schedule 3 or 4 to look at tomorrow, send them to me. I'll send you back the payments on each 4. That way you know what you're looking at. You can compare payments to property. Because what happens if you have a $340,000 home that needs a lot of work? and the payment's a little lower than the 370, but this 370 is perfect. You don't have to put a penny into it. Then you can say, well, the 370 only cost me, $100 a month. Is it worth it? So when you have that power and information in your hands, you can make the decisions. And once you make a good decision, you want to make sure you have a team behind you to protect you, because there's certain phrases and things in the contract that if you don't have guidance, it could affect you in the future if you don't do things within inspection period within the grace period. And that's where their professionalism as realtors come into play. And we all work together, because once you guys find the house, he's protecting your benefit legally, contract, and I'm looking out for your benefit financially. So we all have to stay in communication and work as a team in order to accomplish that. So most of the time, everybody goes through FHA or conventional, because those are standard income verification programs. Now, they have adopted some alternative programs to the non-income. For example, some people are not all W-2, some people are self-employed. Some people are self-employed and make a lot of money, but they show very little, right? They're still very valuable clients in the eyes of the investor because they have liquidity. It's just that their taxes don't reflect it. The net income doesn't reflect what they didn't make, but they have money, good credit, and they have a good name history. So the first alternative that we offer is, if someone is self-employed, they have a business for at least 5 years, we can offer a 1-year tax return program versus a 2-year tax return program. Sometimes when you take an average of 2 years, if you did 40 and 80, you only have 60 to qualify with. But if you can prove 5 years that you've had the business, we can qualify you with a 1-year tax, and now you qualify with 80. Very valuable, because if you don't qualify for the 60, that means that you have to do your taxes again for 80, pay the IRS 20,000-30,000 to qualify, and still wait more time. So this is an alternative program that we offer to someone who doesn't have the W-2 income. The second alternative, now when we go to this program with 1-year tax returns, obviously the amount of money down is higher when you have less documentation. So you start off with FHA 3.5%, conventional 3%. You can go to a 1-year tax returns 5% down. Then we have another program which is strictly 12 months bank statements, business, personal. Take the average of your monthly deposits, you use 50% of that for your income. That requires 10%. And then finally is our no income verification, which is more for investors. You'd have to put 20% down, but you can qualify as long as you have a 7 credit score. A lot of financing information I'm giving you just so you have it as common knowledge. Most of the time, everyone goes through FHA and conventional. It's one of the best perspective on financing options.
You want to add something else? That's a size credit too for those people? Or?
Yes, for more for the investor type. We have sometimes, let's say the investor has good tax returns, but as far as gross income, but their net income is low, high credit score, but they're missing funds to close. A lot of self-employed people could qualify for a business credit line. So let's say you have a business and your gross revenue was 200,000-400,000 last year, but your net was only 20-30, expense everything out. As long as we can present a strong revenue in the business, we could qualify for up to $100,000 business line of credit with no income verification, just with a 700 score. Those funds can be used to purchase a property as an investor if you have no income verification and you have up to 20% down. So there are very good alternative programs now for those categories.
And also a couple of things, some people selling their homes and they wanted to get cash, you know, to pay cash for a property and then sell theirs later. There are some programs there as well. First, they can get equity line and cash, get cash from your equity line on their property. Another thing that they can do is there's kind of like a bridge loan that gives them a loan on the new property. They still have to pay payments on both of them, but you know, it's not so much the details, but that people are aware that that's out there. Okay?
The value of the bridge loan is that when you want, if you want to sell your home to buy another one, and it's contingent upon the sale, some sellers won't accept that. They want to make sure that you can buy your property, buy their property, without having to sell yours. So that bridge loan serves as a short-term loan to buy the property, and then you can pay it back when you sell it.
I keep looking at that slide, we've gotten the cover, but if you're in the approval process, don't buy any big purchases like a new car, because it'll blow your deal. Even credit cards, don't change your job without talking to Fabian. And with down payment money, you know, we have some rules to it too, so that you're aware of. But, you know, there's one more thing we want to cover here, which is the Florida Hometown Heroes Housing Program. DeSantis approved $100 million towards homeownership for first responders.
Okay, well, yeah, questions for Dan?
Yeah, let's cover a couple more things and then I'll do questions, okay? And then, so, you know, this basically can get up to $20,000, is it $25,000. So there's a list and a bigger chart. If anybody qualifies, we can email that to you. Teachers, veterans, firefighters, chiropractors, orthodontics, Pedorthist, you know, ALF administrators, healthcare. So there's a lot of extra. It's just not the main, you know, first responders, but you know, a lot of admin, nutritionists, childcare operations, dentists, massage therapists. So there's a whole chart of a lot of other jobs. So if anybody wants to know, we can get that chart to you. But the way that program works is you can, you know, they give you $25,000 that you can use to buy your property, and you keep it for 30 years. It's interest free. At the end of 30 years, you have your home paid for. At that point, you got to pay it back, right? You know, it's unless you sell the house or move out. You move out and rent, you got to pay.
Yeah, you leave it or sell it. Or refinance it, never.
But if you're gonna stay in your home, yeah, 25,000. And even if you, let's say you make a move in 5 years, hopefully the property's gone up in value too. It helps you get $25,000 to start building wealth in that property, and we'll later on have to pay back. Is there anything else you know there?
Just as long as single funds are available, just look at who you want to.
Okay, all right. And then, you know, obviously that, you know, after all of that, the next step is finding your home. You know, and not every home's going to be perfect and have everything that you want. You know, so one of the things is in the middle of the road is close to perfect. Those are the things we'll be working with you as your agent. You know, some of the main things are location, size, condition, the neighborhood. You know, is the structure of the property. You know, you want to drive around and make sure you like the neighborhood. We recommend that as well. Is it close to your work? You know, what community, you know, things in schools, shopping is there, you know, and then, you know, what is a must have and what is a want? That's we're going to go and sit down with you one-on-one to help you. That we'll be asking. And then, you know, we'll be going out and you know, condos to townhomes, you know, obviously those are more affordable. That's 90, but there's HOAs in there. And there's certain rules on the HOA. We can look at the construction together. Right now, they're giving some incentives on new construction since the inventory is they're starting to build them out. And things are slowing down. So when we go in there to construction with you, we can negotiate incentives or, you know, extra things into the house for you. You know, at that point, once we find the thing is we make an offer, we work on the contingencies, work over the inspection. Inspections are generally as is contracts used for major items. You know, so, you know, if there's small things, you know, when you're buying a house, you may need to look at it. If you're obviously got to look at your budget. If your budget's really tight, then you want to look at a house that's, you know, maybe a little bit newer and has everything in place.
Sometimes you can get a better deal if someone's handing them to do painting and cosmetic things themselves. As long as the major things are good. But there is an inspection period, where we can take a look at and protect you during those things. Also, all the loans are subject to an appraisal, so you're protected that, you know, if you're buying a home for 300 or 600, that the appraisal comes in at those numbers, or not, you can renegotiate with that. With this, you know, there are some costs in closings, generally 2% or 3% of the loan. You know, an inspection could be 200 to 600. There's a survey that the bank requires. It's like $400, $500. You know, the good thing is when we move forward with Fabian, we'll give you that in writing, so you have a better idea of what those are. And then at this point, do you have any questions?
Going back to the FHA loan that comes with the mortgage insurance. So putting down about 3.5%. If later on you surpass that 20% that was supposed to be put down, well, according to what the commissioner was for 20%, that doesn't come with the insurance. Now, if you start with FHA and you put 2.5% down, but then with your payment, you kind of go over the amount of 20% should be, would they take away the insurance, or does it matter?
They don't take it off, right? On FHA, the mortgage insurance is for the life of the loan.
If you put 20% down with FHA, it's gonna be a little less than you put
I guess I'll have it.
You will have it for life, but I would always probably steer you towards going conventional, not having mortgage insurance at all, even if you have to pay a little bit higher rate if you had a lower score. If you had a 640 or 660 score, you might have a little bit of a higher rate conventional, but you won't have mortgage insurance. So I'd rather you take that extra money and put it towards principal and put out your mortgage faster. So case by case, but that's a good question. But yeah, that's the downfall of FHA is you never get rid of the mortgage insurance without refinancing it.
But the really key part in that is just a little more detail in that. So once you're ready, we know the price range, what you're approved at. You know, Fabian giving you a side-by-side comparison. This is the numbers on FHA, this is the number on conventional. The rates could be a little bit different, the mortgage could be a little bit different, but you can kind of do a side-by-side comparison and see what's best for you. Okay.
Don't forget that.
Then at that point, you could get one.
Don't forget that the FHA, yeah, they're a little bit strict with the mortgage insurance for life. But at the end of the day, you don't know how many people were able to get their dream home with FHA because the parameters were more flexible than conventional. So there's sometimes a cost of doing business, but it's very well worth it. You're never going to be penalized because you can't always say, oh man, I'm going to be penalized by FHA. But no, I'm getting a home that I would never be able to get unless I did XYZ and I have to wait 2 years. So the fact that it's available for us in circumstances that are, questionable, at least we have an option. So I never had anybody complain about it before because they were grateful that it was available. Don't be afraid of that, but on the lending side, investors said, you know what, I have to protect my risk. If I'm going to take a higher risk, I want to make sure that the mortgage insurance is in place no matter what, because if someone defaults or looking for foreclosure, at least me, the lender, investor, is protected, and that's what.
And I'll give you a scenario. In the past 6 months, we were working with the buyer, Fernando and I, and the buyer had gone somewhere else. I don't know if the agent was experienced or, just not up to learning his trade, which is common. And they went out and showed us a property. Then the people landed their dream home. It was one of, obviously everybody's looking at it, it's priced right, ready to go. The seller was motivated. And then by the agent never told them to come to the seminar, never told them to get your pre-approvals in order first. So then let me see, they made an offer without their pre-approval. They never got the offer, of course. And then, that person was so upset, they came to us, we were able to help them out. So it's great that you're here and learning this all up front, and then you take that first step of getting approved. So like we said, we can all work together, you as the buyer, us as the agent, maybe as a mortgage people to get your goal to buy that home, and be out of the buyers, because the worst thing that I've seen in my 35 years experience is when someone like that came to me and they found their dream home and they weren't able to get it. Because a bad situation like that, another agent, or they simply, didn't go listen to our advice and go stronger in that case on the offer. And then they didn't get that property and there was that was a dream home, the other ones were just never a thing. So that's one of the worst things that I see that happens out there. So that goes back to, being great. It's a great question.
And we also, we're gonna tell you like it is, good, bad, or different. There's no sugarcoating because this industry is changing every single day. The products are changing, the programs are changing, things that we have no control over. So when we sit down and we give you terms, based on our experience and professionalism, we try to give you the best and most accurate information that we can. And then we always like to have a plan B and C in place just in case something comes up that we're not prepared for. So we're gonna be, brutally honest on everything, because I can't issue an approval and have you go into something 50-50. You have to know what we're up against. If I see that, let's say for example, I do your approval and we're like really, really tight on our ratios, and I say, look, any little thing, if insurance comes in higher, we could lose our approval. Or if this happens, so knowing the potential red flags ahead of time, I can ask you, hey, in the event that this happens, can you have this, this, and this? And that way we're properly prepared, and that way we don't have any, not blindsided with any surprises.
So if I have any new credit card, how long do I have to wait till I do approval process for approval process?
Well, that's a good question. So, conventional again is more strict. They want to have at least 3 to 4 cards or liabilities that you're paying for at least a year to 2 years consistently. FHA, I think, only wants to see that you have some credit history for 6 months. So with newer cars, it may be easier with FHA. Conventional could say that you don't have enough credit history.
And sometimes
What if I
can't
do-
you add in your phone bills and your utilities or some of
You
those?
could have an authorized user with somebody who has.
What if I have 3 major credit cards and I have pretty good history, and I just wanted to add another one on the fourth, but it's a new one?
It's not gonna hurt you at all. My only advice would be if you do take on credit, use it as a building block. Sometimes if you have a $500 credit limit and you use the whole 500, the minimum payments is gonna start sucking your credit. If you use it to build your credit up, you actually can strategically use that by, let's say, if you have a 500 credit limit, let's say you spend 150, 200 a month deliberately. And when your bill comes, don't pay it off, pay it down like anywhere between $10 and $50. For whatever crazy reason, it has the highest effect on your credit score. And you do that way. Paying them off for whatever reason, I don't know, it's just their algorithm, doesn't necessarily give you the best benefit. So use it. But once I pull your credit and we're in an approval status, our advice would be please do not acquire any new inquiries, debts, purchases, because those things could come up and require a new credit pull or could affect the ratio. So we want to halt any new inquiries and new credit cards.
But if I don't support it for approvals, if I go and get a new car before I start in for approval.
Well, I would prefer you to ask me first because
You-
because that could
you
affect
gotta
your
go
ratio.
things. I think the best thing is you have a one-on-one conversation with Fabian and you tell him specifically what you want. You can look at your debt ratios and can tell you, look, based on this, your work, you can do this much. If you got the new car for this amount, it might knock you down from 350 to 300 or whatever those numbers are. So it sounds like a one-on-one would be a better approach to asking to get those answers in detail.
That car payment could be the difference whether you qualify for 320 or 1. So probably would be your best interest. Right? if at all possible. If you're gonna have a problem.
I have a question, maybe you can just clarify the, bureau fire thing. Yes, that one, can you like clarify, like, one more time, so you would receive up to 25,000 based off of your income or your occupation or what is that?
You have to qualify.
I was,
You have to qualify. There's, you know, there's a little bit more restrictions for the program. There is an income limit that if you exceed it, then you're no longer eligible, which I think, I gotta double check it. Maybe 100, depends on how many people run the application, could be between 80 and 128. So we'll double check that. Once we submit the application, we'll, you know, they gotta reserve the fund, see if it's available. It's a little longer process, but it's worth it.
And it's just based on your job, you know. It's-
yeah, no, I work in,
There is a credits for, the credits for that applies for conventional FHA is what the system gonna apply, will approve you or not. So it's gonna, you're gonna get approved through one or the other. The only thing is there are restrictions on that's information. So it may help or may not, help. So we'll see. Well, that will have to see what we'll see.
they should be a part of that program and also do first time buyer, or do you have to like pick and choose?
Well, you see, technically, you know, there are benefits to FHA for the first time buyer. It's more for having more flexible limits in buying, kind of forego some of it because they should be a little more strict around the ratio. So let's say if you get the 25, you might have a little more strict qualification versus not. So you kind of,
The option.
you gotta weigh your options.
Any other questions?
I do. You were saying about my have to go on.
Well, I mean, go ahead and ask, but just to get more detail and understand, that
so-
would be better, but we're here to answer.
Self-employment.
Mhm.
Supposed to build up a little bit, but I don't quite understand what's the,
A self-employed individual would be someone who gets 1099 or who owns their own business.
so if I don't have a business, but I'm self-employed, how does that work with someone I get a home?
So you have your own business, so you must run it through your Schedule C.
No, you don't.
I don't own a business.
So you don't.
So you got someone who's working as an Uber driver, they don't have their own business.
Get it tonight.
Right, so what happens, you get 1099, it goes into your Schedule C, and basically, whatever your gross is, right? After your deductions, the net is what we use to qualify to your average,
So then that is the money after taxes,
leftover after expenses.
after expenses. So where did the tax comes in, because I'll have to pay taxes at the end, so.
It's the $1 million catch 22 that everybody has. It's, you know, a lot of people try to avoid, you know, paying too much to the IRS, but then their net income is lower, which they should be qualified. So sometimes you just bring in another person, you have another person to get a little more income.
So are they looking at how much I've been saving with all the growth that I've got, is that what it is, like? 'Cause I don't get like, how much we spent, so they're gonna look at how much I've been spending raw.
That's what you put on your tax returns, right?
Correct.
So let's say your 1099 is whatever. 68,000 to 50, whatever that number is, right? If you don't claim any expenses, they use the whole thing, but if on your tax return you claim expenses. And you cut that in half, for example, 80 to 40 as a number, then they're gonna use that number. So it depends on the tax returns.
And when you're self-employed, you have to take it to your average of your tax returns. So, and it's the net amount after all expenses.
So it's better to claim purchases or not good to claim? What is that?
Well, let's see, that's something that we can't advise you. I can't tell you if you make 80,000, don't pay any tax expenses, you just declare 80 and then go to the IRS 20,000. I'll tell you, speak to your accountant. I mean, most likely you tell your accountant, listen, I wanna buy a house, can you please guide me accordingly? And they'll work the numbers out to your best benefits where you're declaring up.
But the best thing to do is set a one-on-one appointment,
Correct.
talk to Fabian,
Yeah.
give them what you do have, and I think look at it in detail and
Right.
tell you and advise you. You know, sometimes people have to take a step in between, but at least you know right up front what you can do right now, or what if you do an extra step that you qualify for after. But it's a free consultation, so, you know. it doesn't
All those
cost you
details-
anything, He's gonna help you in detail.
You're not even gonna have to ask. Because I already go down the list and I say, okay, credit, income, assets. What are we missing? What do we have? How do we solve the problem? Do you have the ability to solve the problem through A, B, and C? So in a 15-minute conversation, I'm pretty much do a preliminary assessment. If there's taxes that I have to look at, then I ask for taxes, and let you know what we need to do.
And then Fernando right now is gonna kind of go over our promise, hopefully we choose John Diaz group to work with, and this is what we base our business on.
So hi, everybody. Fernando, I'm the lead buyer consultant of the team. In a way, I'm the face of this organization. In this side of things, I connect everybody with all of the services. One of my big goals is to make sure that we keep our promises, just to work as a team to ensure that the entire process from start to finish is smooth and seamless. To set expectations and make sure that we're solution based, to get in front of any problems that might have appeared, to make sure that you have an exceptional experience, that we are loyal, that we're understanding, that we're attentive. And then every time that you think about real estate, or you have somebody that needs help with real estate, you can think about John Diaz Group, Williams. Besides that, I'm always will be the person to help you from the start to the finish of the process, make sure that you get people helping you with Fabian, making sure that you understand everything that you need, everything that you want, help you navigate the entire process. Once we figure out what we're looking for, what the approval is like, and make sure that we send you the properties that will make sense for you. Instead of sending you 1,000 of them, we send you the ones that are right for you, so you miss your chances. We make sure that once we find the right ones, we go see them. If the right one appears, we come for now, I'm ready to go. I say, let's go. I help you negotiate. I hope you write the offer. Once we go under contract, we make sure that everything gets done. Making sure the appraisal is done, the appraisal inspection gets done, that the title is correct. All of the little paperwork that takes place in there gets done to even to the closing table. Okay, basically, it's making this as easy as possible. I help you navigate and make sure that there's no mistakes happening.
And with that, you know, Terry Keller, who's the owner of Keller Women's Realty, you know, just wants to book your first home. It's a newer book that just came out recently. So part of it's on there, we're gonna put these out. So hopefully you enjoy the information and enjoy the book, and you work with us as you get ready to buy something. And we're holding these seminars